Coming up on Market to Market, the White House floats a political trial balloon that would lay the estate tax to rest. And an unlikely Midwest-East Coast partnership creates long-lasting benefits. Those stories and market analysis with Tomm Pfitzenmaier next.
All kinds of big acreage.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, September 29 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The delayed economic impact of hurricanes and tropical storms is spreading beyond the impact zones in the South and Caribbean. For those living in Florida and Texas had a bleaker outlook on the future, which dropped consumer confidence last month. New home sales, struck by Hurricane Harvey to some degree, fell 3.4% in August. Orders for durable goods lifted 1.7% on the wings of more aircraft sales. Without the turbulence added from airplanes, the rate moved 0.9% higher. And the Environmental Protection Agency, defying President Trump's campaign promises, wants to reduce RFS obligations by cutting biomass and biodiesel requirements. The EPA also asked for ethanol exports to be included in the total. Reactions from biofuel supporters has been decidedly negative. President Trump had another policy proposal this week, rolling out his vision of a new tax code. If adopted, farm country could reap the benefits. Paul Yeager has more.
This is a once-in-a-generation opportunity.
The president's $5 trillion plan would cut taxes for corporations, potentially for individuals, and simplify the system while eliminating some policy closely watched in rural America.
We want tax reform that is pro-growth, pro-jobs, pro-worker, pro-family, and yes, tax reform that is pro-American.
Details are scarce, leaving room for Congress to shape much of the plan. The GOP blueprint does increase the standard deductions to $12,000 for individuals and $24,000 for married couples, most likely through the elimination of the personal exemption. However, the bottom tax rate would increase from 10 to 12%.
The top rate on the wealthiest comes down, and the bottom rate on working class families goes up. What kind of plan is this?
One of the cuts proposed would eliminate the estate tax. Long known in rural America, it is viewed as the death tax by some and seen by critics as a boon to an already successful upper class.
To protect millions of small businesses and the American farmer, we are finally ending the crushing, the horrible, the unfair estate tax.
Currently, the gift tax exemption allows up to $5.4 million per individual to be left to heirs. After that, the rate of taxation is 40%.
Republicans are giving $269 billion to the richest 0.2%. The president said he didn't want to give tax breaks to the rich. Then he should this afternoon denounce repeal of the estate tax, which goes exclusively to the rich.
In farm country, $5.4 million is the average value of 764 acres of Iowa farmland, which according to USDA is nearly twice the size of the average Iowa farm. Iowa Senator Charles Grassley, a farmer who owns more than 600 acres in the Hawkeye State, sees the plan as a win for big cities where small businesses create jobs and also for farmers.
I have a lot of people in my neighborhood that would fall into the category of having to pay a state tax, and they worry about it. Now, is that worry legitimate? You know, you have to ask them. But they feel strongly about living conservatively and getting an efficient operation and leaving it to future generations. That's how family farms exist for the most part, is people of the next generation taking over.
Critics of the president's proposal say farmers get used in the political play involving the estate tax, as so few instances occur each year. Budget hawks see the potential of increasing the federal deficit as another downfall. Officials for the farm trade group National Cattlemen's Beef Association say member farmers and ranchers are small business owners who could benefit from comprehensive tax reform.
And it's important that the tax code work for them and the unique nature of farming and ranching operations. We will be fighting until the very end for full permanent repeal of the death tax.
The Nonpartisan Tax Policy Center says only 5,500 of the 3 million estates settled in 2017 would have to pay any taxes. And of that, only 80 would have to pay the estate tax. Back in 1977, 139,000 estates had to pay the tax, but lowering the rate and raising exemptions has changed the scope of the issue. When asked about any specific instances of heirs having to sell portions of farms to pay estate taxes, Grassley could not immediately cite a case. For Market to Market, I'm Paul Yeager.
Like many bulk commodity producers, dairy farmers take the price they are given by the market. Things can get difficult when the passion for running a dairy operation collides with the realities of making ends meet. However, producer Peter Tubbs found a family that threw away the conventional model and took a different path to prosperity.
1,200 Holsteins receive their morning milking at McCarty Farms in Rexford, Kansas. Their milk is high in volume and butterfat compared to other Holsteins in the dairy industry. And the path their milk will take to the customer is unusual.
We desired a greater connection to the consumer, a greater connection to the people who bought our milk, and a greater valorization of what we felt were our best practices, in the hopes that in doing that, it would create a better economic model.
The evolution of the model originally began when the McCarty family moved in 2000 from Pennsylvania to western Kansas in search of lower feed costs. Yet a decade of low dairy prices kept profits at the family business thin. The pursuit of a different business model led the McCartys to Dannon, the largest yogurt maker in the United States. The McCartys were looking to stabilize a volatile bottom line. Dannon was seeking price stability for its products and had specific needs for its raw milk.
We envision a food system that is a little different than it is today, in the sense that we want to be working with Mother Nature and with the dairy farmers to change how food is made, because that's what shoppers are increasingly looking for.
Changing consumer preferences are driving food producers to design supply chains that allow traceability of their products right down to the farm. Several companies, Dannon among them, have found consumers that are interested in traceability are willing to pay a premium for the privilege.
And more recently, we've just introduced our first non-GMO Project Verified yogurts, which are verified to the feed of the cows.
80% of the dairy's forage is purchased from the region. The 8,200 milking cows that McCarty Farms milk at operations in Kansas and Nebraska have been on an entirely non-GMO feed regimen since June of 2017. The process of creating a non-GMO feed supply took 18 months and required the McCartys to convince local farmers to change their seed preferences. For the McCartys, the increased costs and record keeping were worth the extra work.
Very warm reception with those farmer partners, and obviously we had to harvest the forages, which takes some time, and then we had to build the entire system of traceability and protocols and whatnot to comply with the standard.
The partnership between Dannon and the McCartys is more than just vendor-client. The bulk milk price the two sides negotiate is based on an open books philosophy. The McCartys open their books and share their costs of production with Dannon in order to earn what both believe to be a fair price. Profitability for both buyer and seller is maintained. Each side believes this open policy is better for both sides of the equation.
Over time, Americans have been looking differently at the foods that they're eating and wanting to know more about where they come from, how they're produced. And no surprise, interest in non-GMO options is growing. And so we, through direct relationships with farms, are now able to provide a non-GMO project verified option in non-organic yogurt that previously was not available. And the only reason we're able to do that is because of the direct relationships we have with dairy farmers and the ability to work with them over a longer term period so that they can plan accordingly for their feed inputs to ensure that they too are non-GMO project verified.
The relationship between Dannon and McCarty Farms also carries environmental and animal welfare expectations. Border areas of the farms are now planted in native grasses to reduce mowing and encourage wildlife. Chemical use on forage ground is limited. Crop rotations are required. The dairy cows have access to feed and shade and are closely monitored for signs of health issues or a change in milk output. The focus on animal welfare has led McCarty Farms to become the first dairy in the nation to earn all 4 Validus certifications, a third-party verification of socially responsible on-farm production practices. Dannon has committed to sourcing milk exclusively from Validus certified dairies.
Animal welfare is something we as a company are very passionate about, the health and well-being of dairy cows. It's also something that consumers are increasingly interested in. And so we believe Validus is the gold standard in the United States. And it's a process that we're so committed to that we put it into the agreements with our dairy suppliers. And it's part of the cost equation that we are also bearing because it's that important to us.
Milk production from McCarty Farms' 4 dairies is trucked to the Rexford, Kansas facility to be condensed before shipment to Dannon Plant number 48 in Dallas, Texas. By evaporating 75% of the water in the bulk milk, Dannon reduces the carbon footprint of its yogurt. The reclaimed water is filtered and reused on the farm for drinking water for the cows, cleaning of the plant, and irrigation of crops. In an arid climate that receives only 15 inches of rain per year, 50,000 gallons of water reclaimed each day represents a large percentage of the dairy's water use. In the short term, the financial details of the changes Dannon and McCarty Farms have made in their supply chain raise the price of doing business. However, in the long term, being accountable to the customer will be the profitable position in a commodity business.
The real goal is, how do I do something that's positive and bigger than me, bigger than us? And I think this model gives you the springboard to doing some things like that.
From Market to Market, I'm Peter Tubbs.
Next, the Market to Market report.
The commodity market spent the week mixed, in some cases treading water before the quarterly stocks report. The last few hours of the week's final session were volatile. For the week, December wheat lost a penny, while the nearby corn contract gained 2 cents. Soybeans trended lower on cheaper product from South America, only to rally after the report. Despite the move, the November contract fell 16 cents. December meal fell $3.20 per ton. Cotton swung nearly $1 to end the week down only a penny per hundredweight. Over in the dairy parlor, October Class 3 milk futures added 12 cents. Livestock was mixed as the October cattle contract lost $2.18 and nearby feeders fell $3.63. The October lean hog contract rose $3.32. In the currency markets, the U.S. dollar index put on 92 basis points. Crude oil moved $1.01 per barrel higher. COMEX gold cut $12.70 per ounce. And the Goldman Sachs Commodity Index added just over a point to finish at 399.10. Here now to lend us his insight on these and other trends is one of our regular market analysts, Tomm Pfitzenmaier. Tom, welcome back.
Thanks, Mike.
In case you want to go over things again, you can download or listen to our Market Analysis and Market Plus podcasts anytime online at iptv.org/MTOM. Tom, let's take a look at this wheat market. Friday was an unpleasant day in Chicago, but especially in the Minneapolis wheat contract. The small grains production report came out on Friday as well, and it looked like we produced a lot more Minneapolis wheat than the trade was anticipating.
Yeah, well, they kind of over-discounted that through the summer, so I guess it shouldn't have been a huge surprise. And then the stocks were up too, and that which is what hurt the Chicago wheat. So yeah, it wasn't a great. I mean, wheat had kind of started to roll over a little bit anyway, so there was some uneasiness about the wheat trades, and this just sort of confirmed the negativity. So I don't think you're going to see wheat fall apart. I think it's trying to put a base in here. There's still a lot of concern about the Australian wheat crop. So we certainly are probably going to have a pullback here technically, but I don't, maybe 15, 20 cents, probably no more than that.
Okay, not going to make a run back to 404 or whatever the low was.
Right, no, I don't believe so. I think we've got a good enough base in the wheat market that we're probably going to be all right there.
How are the commercial traders sitting? They had been very short that market, then they kind of came back to even. Where are they today?
They're still marginally short, but
okay.
Again, I don't think they have a position that shakes anybody up one way or the other too much.
Okay. Now let's talk about the corn market. We saw some favorable news in the quarterly stocks report on the corn side. Could you kind of break down some of the numbers for us? What most surprised the market?
Again, the feed usage was up a little bit, and so that pulled the stocks back. I think about 57 million, if I'm correct on that. So they're going to translate that to the carryout on the October 12th WASDE report, and it's going to pull carryout down a little bit. Big deal. We're still going to have 2.2 plus billion bushel of corn sitting around. That's why all this bullishness in the market on Friday only generated about a 2.5 cent rally. So some of that was the market getting a little bit oversold, and everybody leaning a little bit to the negative side going into the report. So I don't know. I think we're still going to be down to what happens with yield when that October 12th comes. I mean, I think that's really going to drive the market more than anything. Certainly exports are abysmal. They were terrible again this week. South America is going to have the market, world export market, probably through the end of the year. So maybe after that things can perk up, but until then, it's going to be a struggle in the corn market.
Now, one of the numbers that surprised me a little bit was the still large amount of on-farm stocks we have of corn, 760-some million bushels sitting on the farm. What does that tell you as we go forward? A lot of farmers are still hanging on to grain.
Here's the really exciting news. They all plan to store this year's crop, too, because it worked out so well for them last year. I don't know. To me, number one, it means we're going to have an abysmal basis for the foreseeable future. Now, maybe if there's a problem with South America, there is a La Nina sort of shaping up, and that tends to reduce. In the 2 years that they've really had La Ninas hit in Argentina, their crop was reduced by about 14% in both those years.
Okay.
So there is the potential for some reduction there, which could be supportive for our corn market. Ethanol production should be pretty solid, but we produce a little over a billion gallons more than we produce, and that's been going to the exported to the Brazilians. Well, with this tariff they've imposed, there's a lot of uncertainty about whether that's going to continue, and if it's reduced, then it's going to back up on our production. So I mean, there's some things that haven't really hit yet, but are kind of worth keeping an eye on, I think.
Well, and with that in mind, Brock in Baxter, Iowa, one of our followers on Twitter at Hanson Ag, thank you, Brock, for the question, is asking, looking out to next year with better than expected yields, still that carryover old crop, how do we protect the 18 crop? And how do we produce, if we produce over the USDA's numbers, is it just look out below?
Probably.
Okay.
I mean, I think you got a shot at that December 18 corn going up over $4, and I'd certainly start selling it at $4 and then scale right up to $4.50 if some unexpected thing would happen to get us up there. So I think that's one area to look at really closely.
Okay.
And then you can wait and set your basis.
Based on whatever happens locally.
Right.
Find your strength.
Right.
Well, now let's talk about the soybean market. We're 16 cents down on the week. It was a pretty ugly early start to the week, finished on Friday with another rally. Quarterly stocks report, we did end up with less beans than expected. Tom, was that really much of a shock to the market?
It was a little bit. Some people were uneasy about whether they were going to reduce last year's crop, which they did by 11 million bushel. So that was part of the reason. Exports and crush have been pretty good. So, I mean, I think it was a bit surprise, but not huge. Again, the market was leaning, had sold off quite a bit this week. Obviously, if we close, we'll still close 16 cents lower. And I think the bean market was also, and you mentioned it earlier in the show, by this RFS and the biofuels thing, and they had bean oil bid up pretty well in anticipation of strong demand for biodiesel. If that goes away, bean oil dropped quite a bit this week, and that component of the soy complex is partially what pulled it down.
Now, I was driving across 80 a couple times across the state of Iowa this week, saw a lot of combines running, getting those beans out, or getting started anyway, for producers who are maybe finding they're a little undersold as we go into harvest season. Do you think and just sell beans right off the combine while we're up in this mid $9 range, or do we have a chance to push a little higher? Would it be worth storing?
Well, the basis is terrible in beans, so I guess if you've got the ability to store at home, I would certainly store and wait for some kind of a basis improvement after after post-harvest into the end of the year, early next year. Beyond that, I think it's going to be hard for it to mount too much, unless there's a South American problem. Now, they've been a little dry in northern Brazil, although they've got rain in the forecast. So, I mean, that sort of stuff is floating around here to keep an eye on. I still think November beans up in the 980 to 1015 range. I think you scale up selling from there. We did peak up into 984, 985 earlier this week. So, you know, that's not that far out of range. But certainly if you have beans, I wouldn't pay a lot of commercial storage to. I think you'll have trouble getting rallies that offset that cost.
Now, after a rally like we saw on Friday, do you expect that to extend into next week? Was there enough motivation behind it to keep it running?
It did turn several of the indicators that I watch higher. So I would guess I wouldn't be surprised at all to see some follow through Monday. Probably muted. You're really in the middle of harvest. Combines are running everywhere. Bean yields are coming in from what we've heard. You know, the guys are saying they're pleasantly surprised. Now, whether their expectation, how that is relative to the USDA's predictions, that's always a question mark. But most guys that I've talked to are pretty pleasantly surprised.
All right. Well, now let's talk about the livestock markets, Tom. We did see live cattle pull back a little bit this week. We are seeing a basis actually return to the live cattle market. Futures are leading the cash market. Where do we go from here? Are we just going to bounce around the low 110s for a while?
You know the thing that concerns me is about that cattle market, and it happens almost every time, is you've got those deferred contracts so much higher than the nearbys. I'm just fearful that that's going to cause people to hold on to cattle, put weight on it. It happens almost every time, and you can understand why, especially if you've got cheap corn to hold them. I don't know. I'm just afraid that you get cattle up another buck or two, and I wouldn't want to be long the cattle market anyway. I'd be hedging it, and the downside is, I mean, I don't think it's going back to 100 or anything. But you certainly could pull back under 110 a little ways.
All right. Could be another $5, $6, $8 here to the downside.
Right.
All right, and not a whole lot of room to the upside.
And there's a lot. I mean, there's the poultry industry has continued to expand. We had a hog report out yesterday. The hog numbers are up. So I mean, there's plenty of meat for people to buy.
Now, feeder cattle, with this corn market just kind of being stuck in these doldrums, with live cattle being stuck, you know, in that low teens area, feeder cattle gonna be able to find any direction?
I don't see how. I don't know how. I think probably the last time I was on the show, we talked about feeder cattle getting down in the 144 to 146 range, and I think we're going back to. I don't see how you maintain feeders up here at 154 to 156. It seems overpriced to me, and I understand they're assuming cheap corn, but that only goes so far too. You'd think lessons would have been learned, but they don't seem to be. So I mean, people are paying big numbers for feeders, and I don't see how they're making them work.
Yeah, and it could get really ugly if we start massively overfeeding live cattle like we did 2 years ago.
Right. Yeah.
That could be.
I know there's a danger sitting out there, I think.
All right. Now, hog market. You mentioned the quarterly hogs and pigs report that came out earlier this week. What did we see on that report?
You know, the interesting thing about the numbers came in almost as trade was expecting, with a couple of exceptions. The over 120-pound hogs were about 2% higher than the trade was expecting. That's why on Friday you saw October hogs up barely, where December hogs were up 230 or something.
Yeah.
It was a great disparity. Well, that was because the under 120s came in a little less than they were thinking. Over 120s came in higher, so you're seeing the front end. Now the futures are quite a ways above the cash market. So, you know, if I was going to be a seller of anything, it would be October hogs in that 155 range, so guarding against what happens over the next couple weeks.
Okay.
Now, if they continue to rally these December hogs up in that 60 to 62 cent range, well, we closed above 60, but 62 cents. I think you have to be a seller too, because we're going to continue to have numbers coming at us. The kept for breeding was as they expected, but it was up a little bit. Intentions were up. So, I mean, I think you're just going to continue to see expansion in the hog market that's going to make it tough to rally. I think you'll see December hogs eventually move down into the low 50s.
All right. Well, Tomm Pfitzenmaier, thank you so much for taking the time to join us this week.
Thanks, Mike.
Well, that wraps up the broadcast portion of Market to Market. However, Tom and I will keep the conversation going, including answering more of your questions during Market Plus, available in podcast and video form on our website. And do you have comments or suggestions for the program? We'd like to hear from you. Send us an email to markettomarket@iptv.org. Join us again next week when Walt Hackney and Elaine Cubb sit across from me at the Market to Market table. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.